You've spent decades building the nest egg. You maxed the 401k, let the IRA compound, bought a rental, maybe kept a chunky brokerage account humming with index funds. Then retirement starts, and a quiet crowd of hidden taxes steps out of the wings. They don't all show up on April 15th. Some arrive as surcharges on your health premiums, others as forced withdrawals, still others as surprise capital gains distributions you never asked for. This is your plain English tour of the stealthy ways taxes nibble or bite at retirement savings, and the simple moves that keep more of your money working for you. Begin with the most basic illusion. The balance you see is not the money you'll spend. Traditional pre-tax accounts are partnerships with the government. Every dollar you withdraw is generally taxed as ordinary income. The headline number in your 401k or rollover IRA is a gross figure. The net, after federal and state taxes, is the part you can actually live on. That's why two savers with the same pre-tax balance can afford very different retirements if one faces a higher bracket or lives in a higher tax state. Don't let the big number lull you. Plan around the net. The second hidden drain is timing. For most retirees, tax law eventually stops letting you choose when to withdraw from pre-tax accounts. Required minimum distributions, RMDs, kick in at a statutory age and grow every year as a percentage of your balance. If markets have been kind and you've let pre-tax money compound untouched, the RMD can catapult you into a higher bracket just when you hope to coast. Those mandated withdrawals can also trigger a chain reaction. More taxable income can make more of your Social Security taxable, can trip health premium surcharges, and can expose investment income to additional surtaxes. One domino, many tiles. That brings us to Social Security. Many people are startled to learn that benefits can be taxed. The system looks at your other income and, above modest thresholds that haven't changed in ages, pulls part of your check into taxable income. The end effect is a shadow bracket where each extra dollar from an IRA withdrawal or a part-time job doesn't just add itself. It can also make more of your benefits taxable. The marginal bite in those zones feels bigger than your official bracket suggests. It isn't a mistake. It's how the formula works. The fix is planning, not panic. Shape the income that lands in those years so fewer dominoes fall at once. Healthcare adds its own stealth tax. Medicare charges higher Part B and Part D premiums when your income crosses certain thresholds, assessed using a recent tax return and applied as an income-related monthly adjustment amount, better known as IRMAA. The surcharge isn't a percentage, it's a cliffed step function, so $1 over a threshold can add hundreds or thousands to a year's premiums. It feels like a tax because it acts like one, quietly raising your cost of living when your reported income spikes, say, from a large IRA withdrawal, a Roth conversion that's too big for the year, a business sale, or a sizable capital gain. You can appeal after a life event like retirement, but the better strategy is to design income so you don't leap a threshold by accident. Investment income can pull a double trick of its own. The tax code treats different flavors differently. Interest from corporate bonds, bank accounts, and many bond funds is taxed at ordinary rates. Qualified dividends and long-term capital gains enjoy lower brackets, but those brackets are layered on top of your ordinary income. If RMDs or pensions fill the base, the room left for lower tax gains shrinks. Add one more layer. A separate 3.8% surtax can apply to high earners on net investment income. Interest, dividends, capital gains, rental income, one's overall income rises above another threshold. None of these numbers live on the same page of your brokerage statement. They appear on the return as if from thin air. The result is tax drag that quietly trims what compounding leaves behind. Mutual funds add a twist that many retirees only discover the hard way. In a taxable brokerage account, an active mutual fund can distribute capital gains each year, even if you didn't sell a single share. The fund sold inside the portfolio, and the tax bill is passed to you. In a year when managers reposition or harvest years of built-in gains, those distributions can be large. You can owe tax with no cash in hand unless you elected to receive distributions in cash. That's one reason index funds and ETFs are often friendlier in taxable accounts. Their structures tend to minimize surprise distributions. Real estate can be a tax friend or foe, depending on where it sits. Rental property generates rental income that's taxable after expenses and depreciation. When you sell, accumulated depreciation can be recaptured and taxed, and gains above that can be hit as capital gains, with extra surtaxes possible at higher incomes. In retirement, a paid-off rental can feel like a stable paycheck, but the cash flow you love can, in certain years, push you over health premium thresholds or into surtaxes far from your mind when you sign the lease. Annuities deserve honest words. Tax-deferred annuities grow without current tax in non-retirement accounts. When you withdraw, the gain typically comes out first and is taxed at ordinary rates, not the lower capital gains rates. Inside IRAs, annuities can be redundant. Tax deferral on top of tax deferral, and their ordinary income treatment on the way out remains. Annuities can still be useful for longevity insurance or guaranteed income, but don't mistake tax deferral for tax reduction. The tax character at withdrawal matters as much as the timing. States write their own scripts. Some tax Social Security, some don't. Some tax pension and IRA withdrawals heavily, some give breaks. A state with no income tax may still fund itself through higher property or sales taxes that hit a retiree's budget differently. If you're considering a move, run the full basket. Income tax on retirement withdrawals, property tax formulas and exemptions for seniors, sales tax scope, and estate or inheritance taxes that outlive you but affect your plan. State math can turn two similar retirements into very different net outcomes. Then there are taxes that don't look like taxes. Phaseouts of deductions and credits quietly raise your marginal rate as income rises. Think of them as sand in the gears of your bracket. Early retirees buying their own health insurance through an exchange face premium tax credit cliffs that act like giant temporary surtaxes if income drifts above a line. People withdrawing from pre-tax accounts to stay liquid sometimes trigger those cliffs without realizing it until renewal season, when premiums jump and feel like a penalty for success. If you plan to leave accounts to children or other heirs, a post-2019 rule change tightened the screws on inherited IRAs. Many non-spouse heirs must now empty inherited pre-tax IRAs within 10 years, not stretch small distributions over a lifetime. That acceleration can push adult children into high brackets during prime earning years. It isn't your tax bill, but it came from your account. Knowing that, some parents choose to pay the tax themselves, converting portions to Roth while they sit in lower brackets, effectively prepaying tax at a lower rate for the family. The thread running through all of this is sequence. What you withdraw, from where, and when. The classic hidden tax is not a line item. It's the compounding effect of a poor sequence. With that in mind, here are the levers that shrink the bites. Use your low-income years deliberately. The early retirement window after you stop working full-time but before Social Security, RMDs, and pensions stack up can be prime time to reshape your accounts. Partial Roth conversions in these years move money from forever taxed to never taxed accounts while your bracket is friendlier. The trick is sizing conversions to fill lower brackets without tripping health premium cliffs or creating a chain reaction. Smaller, repeated conversions often beat one giant leap. Match the account to the asset. Put tax-inefficient assets where taxes are least painful. Interest-heavy bond funds, REIT funds, high turnover strategies, and active mutual funds sit more comfortably in IRAs and 401ks, where their yearly income won't be taxed now. Broad stock index funds and ETFs with low distributions and long-term gains often belong in taxable accounts where the lower capital gains rate and step-up at death can help. Roth accounts are precious real estate. Assets with the highest expected growth can belong there, so future gains are never taxed. Manage capital gains like a professional. In taxable accounts, realize gains on your terms. If you're in a year with lower income, you may be able to harvest long-term gains at favorable rates. In higher income years, consider deferring sales or pairing gains with losses you've harvested. Watch for year-end mutual fund distribution announcements. If a fund is about to kick out a large distribution, buying just before the record date can hand you a tax bill for gains you didn't participate in. Coordinate withdrawals with Social Security and Medicare. If delaying Social Security raises lifetime benefits and gives you a few more gap years for Roth conversions at friendly rates, that delay can pay twice. Bigger checks later and a better tax profile now. Keep an eye on Medicare income thresholds starting 2 years before you enroll. Plan large one-time income events. Home sale exclusion limits, business sales, Roth conversions, in years that won't also trigger new surcharges. If a spike is unavoidable, know you can often appeal surcharges after a life-changing event like the end of employment. File the form and tell the story. Give with precision. If charitably inclined and subject to RMDs, qualified charitable distributions from IRAs let you send money directly to charities and count that against your RMD without raising adjusted gross income. Lower AGI can mean lower taxation of Social Security, fewer surtaxes, and better odds against health premium surcharges. Donor-advised funds, funded in a high-income year with appreciated securities, can lock in a deduction while you grant to charities over time and wash embedded gains in the process. And mind the calendar. Tax law is a calendar sport. RMDs are annual. Surcharges look back a year or two. Capital gains distributions cluster in December, and health exchange credits measure full-year income. Look at your year in the fall, not in March. If you're going to sell a big asset, coordinate with your other income. If you're close to a threshold, nudge a distribution into January, not December. If your mutual fund just announced a large distribution, consider replacing it with a more tax-efficient alternative before the record date. The right answer isn't always the lowest tax this year. It's the lowest lifetime tax that still fits your risk, cash flow, and estate goals. Sometimes that means paying a bit more now to avoid paying much more later. Sometimes it means choosing the simpler, more durable structure even if it isn't the perfect tax optimization. The plan you can follow beats the one you admire but abandon. One last quiet enemy: inertia. Hidden taxes work because they're easy to ignore. You don't see the IRMAA until the letter arrives. You don't feel the mutual funds distribution until the 1099 lands. You don't notice the RMDs domino effect until it lights up 3 different lines on your return. Counter that with a once-a-year, 2-page checkup in plain language. How much ordinary income do I expect next year? How much room do I have in lower brackets? Am I near any cliffs? What assets sit in which accounts? What can I convert or realize on purpose? What charitable tactics fit? How do state taxes change this picture if I move or work seasonally? It isn't complicated. It's just deliberate.